Thanks for clicking. The cost of U.S. debt appears to be on the rise again, as on Thursday we saw one of the worst Treasury auctions since the beginning of the pandemic, with traders worried that growing U.S. debt needs will overwhelm Wall Street.
Just print your own money.
Yields on U.S. Treasuries, what the U.S. government pays to service its debt, shot up almost 20 basis points in one day, with yields on Canadian bonds, what we pay to service our debt, following suit thereafter. And while we talked about rising U.S. debt needs a few weeks ago and how that will translate into a higher cost of borrowing for Canada and hence a higher cost of borrowing for your mortgage, Thursday's ugly auction of U.S. debt shows that problems are already starting to emerge. So what I want to do today is go over what happened on Thursday with investors balking at the purchase of U.S. debt, discuss why it's concerning given the current geopolitical context, and then discuss some implications for Canada. Speaking of implications for Canada, Bank of Canada Governor Tiff Macklem warned of higher rates on Friday, noting that the bank isn't seeing any major downward momentum in inflation. Canada's new inflation rate is set to be released on Tuesday, and we'll obviously have an update out on that rate on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into U.S. debt. So, what happened on Thursday? The U.S. was set to auction off $20 billion of new 30-year government bonds. Basically, the U.S. needs more money to finance its ever-growing debt, and it gets that money by auctioning off bonds. Promises to pay.
I needed a little bridge loan.
Yeah, pretty much. And historically, demand for U.S. debt has been fairly high. Investors want to lend the boss money, as the boss has the means and the wherewithal to pay it back in one way or another. And while this has been the case, especially in uncertain times, Thursday's auction shows that that may no longer be the case. Investors balked on the yields, or the return, being offered on the new bonds, sending the yields on the bonds higher than that which was expected. So, big investors, big buyers of U.S. government bonds, pension funds, central banks, insurance companies, etc., balked at lending the U.S. government money at the rate being offered, and, as such, the dealers, or the banks, had to take a larger share of the auction. In fact, primary dealers, rather than investors, took 18% of the bonds being offered, which is much, much higher than the 11% that they had been taking for most of the year. Big investors didn't want the bonds at the rate being offered by the U.S. government, and as such, the big banks had to take them. And this wasn't the first time during the week that this had happened, with the U.S. seeing two other weak auctions of 10-year and 3-year bonds earlier on in the week. So the U.S. government needs to borrow money, and a lot of it, and investors don't want to pay the rate being offered by the government. And the news made Bloomberg, with Lisa Abramovich and John Farrell asking how high yields need to go before they're attractive to investors.
People don't want to buy right now.
They don't want to buy. Is that buying going to come back if yields go back to 5%, 5.1%, 5.2, 5.50? Jamie Dimon 6, 7,
8.
Who knows?
I mean,
And let's be clear, regardless of the jargon, they're asking how high of an interest rate does the U.S. have to pay before investors are comfortable lending it money.
I should not have to be coming here, hat in my hand.
And while we've talked before on this channel about growing U.S. debt needs and how investors are demanding a premium to take it on due to inflationary concerns, appetite for U.S. debt right now should be ultra high. Traditionally, demand for U.S. debt is high during periods of crisis. Again, when times are tough, all things being equal, your money's going to be safe with the biggest guy on the block. And we saw this earlier on in the year, when investors fled to the perceived safety of U.S. Treasuries during the SVB crisis. We also saw it when the gilt market blew up almost a year ago, and we saw it again at the onset of the Russian invasion of Ukraine. With that said, yields didn't stay low for very long after the invasion, as everybody knew that the Fed was going to be raising rates, and raising rates substantially.
Everybody got it except me.
And we saw it again on Friday with news coming out of the Middle East, and investors once again piling into U.S. Treasuries, sending prices higher and yields lower. But given the current geopolitical context, given the current level of uncertainty, we shouldn't be seeing yields on U.S. debt, yields on U.S. Treasuries spike up by 20 basis points in one day in the aftermath of the auction. Were it not for the current crisis, yields would probably have remained much higher. So, right now, investors still like existing U.S. debt that's already been issued, but they're not as keen on the purchase of new debt, of which the U.S. has now issued $1 trillion since June. Investors right now are hesitant to take on a 30-year U.S. government bond, paying less than 5%. And we discussed this a few weeks ago, with current US debt sitting at $33.5 trillion and expected to reach $35.04 trillion in 4 years' time. Actually, it was projected to be $44.96 trillion a few weeks ago, but has gone up by $80 billion in that time.
Well, there's nothing to worry about.
Well, and these projections are based off current interest rates, and as the US Treasury auction showed, the states may have to pay more to service its debt going forward, which would obviously put even more pressure on the servicing of that debt. As the US borrows more money at higher rates to pay back old money at lower rates, more and more pressure is going to be put on its deficit. Imagine borrowing from your credit card at 18% to pay off your mortgage at 3%. So, all in all, further signs of stress in the US Treasury market, with investors refusing to fund at current rates, sending yields higher. And, of course, as we've talked about before, when it costs the US more to borrow money, Canada follows suit, with our yields shooting up on Thursday and then falling on Friday. They shot back up again on Friday after Governor Macklem's comments, but that's a story for another time. So, while many eyes will be on the Bank of Canada when it makes its October 25th announcement, and numerous rate predictions and real estate predictions will obviously ensue thereafter, let's remember the geopolitical context matters. Matters as much, if not more, than our own central bank. And when the US pays more to service its debt, that means Canada pays more to service its debt, which means with fixed rates, you pay more to service your debt. Fixed rates will go up if yields continue to rise. With that said, we will obviously have an update out on the Bank of Canada's decision coming out on October 25th. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.